Hey, in this video, we're going to review TransUnion. So with Tykr, we like to do a 4M analysis. I've mentioned this in the previous videos. And what we do is we start with the math part of investing. That's the margin of safety. Then we move on to the meaning, moat, and then management. So let's dive in. Okay, when you first log into Tykr, you can see in the upper right, the summary is on sale. So that's a good sign. The score is 19 out of 20, which is nearly perfect on the score. And then the margin of safety is a margin of safety of 80%, which shows a lot of upside potential. So let's talk about that a little bit. With the summary, most stocks will not be on sale. Most will be classified as red or overpriced. So this is a good sign right away. With the score, this shows the financials are looking really strong. We use a scoring system to pretty much summarize all the important metrics in a stock. So we pay attention to metrics including the revenue, the net income, EPS, the cash flow. We also pay attention to debt, assets, equity, so on and so forth. And what we do is we look at data points over the last 5 years to really show growth year over year on the important metrics, including that revenue and net income. So in this case, this shows that TransUnion is growing year over year from a financial standpoint. It's looking really good. When you look at the margin of safety, for those that don't already know, with the margin of safety, that's the difference, that's the share price difference off the sticker price. And you can see in the top right here, you have a share price of 102 and a sticker price or fair value. This is also known as the intrinsic value, is 516. That's the actual value of the stock today. If you're interested, you can go to our Tykr.com. There's an education section, and there's a section in there you can actually see the calculations we use. It's all open source, so you could, of course, go use these calculations, create your own version of Tykr in Excel if you really wanted. So with this, we can see that we've got a significant margin of safety, a lot of upside potential with the stock. But let's take a little closer look at the financials. When you jump to the financials tab, we like to lay out the data in a graphical format to show the importance of increasing numbers year over year. So in this case, when you look at the income statement, you can see the revenue. You've got a nice increase, slow and steady year over year, which is a great sign. I'm just going to back this up a little bit to get a larger view going back in time. And look at that. Nice, consistent increase year over year. This is exactly what we want to see. Let's jump to the net income. We can get a better look here. Pretty consistent if you go back a few years. Nothing impressive, but a slow increase. I see 2019 through 2021 with the most recent year. Significant increase in net income. That's a great sign. And then you jump over to earnings per share. That's very similar to your net income. Essentially, earnings per share is net income divided by the outstanding shares in the business. So whenever you see net income, the graphs are going to be pretty similar to EPS. You jump down to the cash flow statement. We also like to see these numbers increase. We can see a nice steady increase. It kind of flat the last 3 years, but still pretty good. It's trending up, which is what we want to see. And then when we get to the balance sheet, the numbers we like to see increase include the assets. Nice increase there. This most recent year, nice bump. That's great to see. And equity, we want to see increase. And same situation. Look at that. It's like perfect, year over year increase. With liabilities and debt, we do like to see decrease. If they do increase, that's okay. Typically, the factors behind that include your biggest liability is payroll. So paying your employees, you are liable to make payroll. As you hire more people, those liabilities will increase. And then debt, if you have to take out bank loans, if you are like, let's say, buying new office space or new equipment, in this case, this business, it's pretty much a tech business. So I'm guessing they're taking out loans to cover costs for payroll, just so they can hire people faster. So overall, financials look outstanding, but we can't stop there. We have to keep moving through the business. So let's talk about the meaning of this business. So TransUnion is a credit reporting agency. The big three are, and you can see when we get to the competition down below, you have Experian, TransUnion, and Equifax. There's a few other reporting agencies that deal with credit. I'm really just going to go over the big ones in this video, really our main competitors. But TransUnion, they have collected data for over 1 billion customers all over the world in about 30 countries. So US being the primary, but they also have locations or customers in, I'll just name a few here. You got Chile, Dominican Republic, Guatemala, Kenya, Mexico, South Africa, and Canada. But let's talk about the business model a little bit. So there's really 3 main B2B revenue streams, and then there's a B2C, a business to consumer revenue stream. So you got the business to business is the primary revenue generator, and then B2C, that's a small little portion of the business. So first off, a lot of lenders like banks or mortgage companies, before they give somebody a loan, they have to pull credit on the consumer. Well, there's a cost every time they do that. Well, those credit ratings are, they're analyzed and assessed and calculated by TransUnion, and then they save that data, and then these lending institutions, they would pay TransUnion for those reports. So that's a big generator for this business. It's a necessity, especially here in the States. If you want to buy a house, you have to have your credit pulled. Same thing if you're buying a larger expense item and you're taking a loan against it, such as a car or a toy like a boat or something like that. If you're taking out a loan, you're going to get your credit pulled, and there's a cost against that. Another revenue generator in the business includes businesses will pay TransUnion for analytics around buying habits, buying behavior, debt habits on people. You can go a little deeper into the weeds with the data they pull on us. It's kind of a scary thing. Don't be too alarmed. These businesses have been doing this a long time, but companies will pay TransUnion and its competitors to get access to that data. And then there's marketing support. Let's say a credit card company wants to offer a specific new credit card to a certain audience. Let's say they want to target people who have a credit score of like 750 and up. Well, you can figure that out if you have the right data. Well, you got to pay for that data. You can get it from TransUnion. So those are the 3 main B2B revenue streams. The fourth stream is more B2C. This is a smaller portion of the business, but they have like credit monitoring, identity theft protection, fraud protection. I pay for a subscription service through LifeLock to monitor my credit, and if there's any pings against it, like in the dark web, you can pay a subscription for that. Well, guess what? TransUnion pretty much offers the same thing in their company. You can pay a subscription fee, and they'll do a lot of that for you. That's primarily the US. When you look outside the US and look at what do they do globally, I know credit can vary a little differently in different countries, but they do have similar products, primarily B2B, where companies that, let's say, they're opening up credit cards in other countries, they have data analytics you can pay for and get access to. They also have fraud monitoring and reporting, but there's various tools that they're expanding globally. We'll talk about this in a little bit because this is an area of specialty with the current CEO. So that's really the business model itself. When you look at this business, the question is, will it be around in the next 10 years? As long as people are buying homes and automobiles and other toys that require loans, yes, TransUnion is going to be around, along with competitors, Equifax and Experian. So as long as we're talking about the competitors a little bit, let's talk about the moat of the business. This is the competitive advantage. So you have the big 3, I call them, TransUnion, Experian, Equifax, pretty similar. Like when you get your credit pulled from, let's say you're going to get a mortgage loan, and those reports, those numbers are going to be pretty similar. They won't be dead on, and we'll go over the differences between each here. So right away, TransUnion, we know they're on sale with a 19 out of 20 and a margin of safety of 80%. With Experian, we can see they're on sale. They have a score of 12 out of 20, a little lower, but their margin of safety is looking really good at 80%. Equifax is a watch, a pretty solid score, 16 out of 20, margin of safety of 46%. Ideally, we want to see a margin of safety of 50% or higher. So of those three already, TransUnion is the stronger investment. And then you have FICO, which it's on sale, 10 out of 20, margin of safety of 80%. So this shows us that credit reporting agencies in general, they are definitely needed and they can run pretty efficient. These are companies that are not selling a physical good, so there's no like manufacturing cost. It's pretty much a tech business. And it's data, and data is really important. I do tell people, if you're going to look for companies out there, look for companies that have a strong emphasis on data. You can be more efficient with marketing, sales, and operations. So with the Moat, right away I can tell you that TransUnion is looking pretty solid against the competition. It's definitely the best of the four. But let's touch on the management. So I'll scroll down here. Chris Cartwright has been the president and CEO since 2019. It looks like he's worked for TransUnion since 2013. And he's served in various executive roles with a few companies I'm not familiar with, including Christie's, and then another one called Wolters Kluwer, which is a information services and workflow company, which to me, probably in the space of data analytics. What was really interesting is he helped expand TransUnion from a US company to a global company. He wasn't the only person involved in this, but he was a big driver to this, to ask the question, how do we serve people with our tools, with our tech stack, with our infrastructure? How do we serve people outside of the US? And he helped solve that or answer that question. And they are definitely expanding, and there's a lot of room for growth here. I think this is worth paying attention to, is who else can you serve outside the US? Like I mentioned earlier, there are a few other countries that we all recognize that are using this company's products. So overall, when you look at TransUnion, you've got we'll just run through it real quick. You've got the margin of safety looking really solid. Score is nearly perfect, 19 out of 20. The margin of safety, 80%, a lot of upside potential there. The meaning of the business, will this business be around in the next 10 years? My opinion is most definitely yes. Again, this goes back to, if you're taking out a loan, you need your credit pulled. There's no way around it. So there's a necessity there. I do like the diversification between B2B and B2C revenue. So that's a great sign. And I do like the fact that they're growing outside the US. The Moat, like I mentioned earlier, they're stacking up really nice against the competitors. They are the best of the four I listed. And then management, I think Chris's experience with global expansion is exactly what you want. So overall, if you're looking for a stock to diversify your portfolio a little bit, let's say you're heavier in maybe non-tech areas and you want to look for something that's not exactly a straight up tech business like we're all familiar with the Amazons, the Googles, the Apples of the world. This is a little more boring, but as Warren Buffett and Charlie Munger teach us, boring is good. And boring businesses are businesses that can last a long time. So this is a great example of a pretty solid, boring business that'll probably be around in the next 10 years. If you have any questions or you have any comments on this, go ahead and leave them below. Thanks.